Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This will be for Friday, December 2nd at the close, getting ready for the Monday open on December 5th. Today we have two reports for you. The S&P 500 Condor Butterfly Timing Report for those of you selling options premium using Condor's butterflies or strategies similar to those. And also we have the S&P 500 Directional Likelihood Report that will help you statistically understand the likelihood of the market moving up, down, or wobbling around for a bit. The current condition of the market is just like this. We have an inside day on Friday following a downswing day. We're above the 50-day moving average while that happened. And in terms of the 15.33 stochastic, we're between 50 and 90, but we're in a downtrend here. We are below the percent D. So all this makes for a very unique market condition that has occurred roughly 60 times from January 2000 up to the present. Only 60 times have we seen that inside day occur under these conditions. All right, so before we get to the methodology of the reports, just as an overview, for those of you that just want to get a brief overview and you've already seen the methodology, here it is. Right now, in terms of a selling edge, a premium selling edge, we're at about 11% positive. Okay, so we have a positive selling edge right now. Now let me see if I can get my, there we go. There we go, I can draw this. Selling edge of 11%. Now let's just go through the line. So since January 2000, there have been over 4,200 daily closes of the SPX. Of those closes, 65.2% have been favorable bars for selling premium. We're using these strategies. Also, during that time, the current condition has occurred roughly 59 times, like you can see there. Of those 59 occurrences, 76.2% of the bars have been similarly favorable for option premium selling. Now, that's higher than the 65.2. That means we have the edge of 11% there. You see that? Okay, so statistically, it's more likely than usual that Friday's bar will end up being favorable for market neutral option premium selling. Okay, so with that in mind, that's the overview of the timing report for condors and butterflies. A positive edge exists. Later I'm going to get into the complete methodology behind this for those of you new to this thing, okay? Now, let's go to the, let me click here. Boom. Get down here. Just a second. Time out. There and then down. There we go. Okay, for the likelihood report, we have a lot of red numbers here, which means that it's very likely we're going to have, or it's more likely than usual, that we'll have less market volatility than normal in the next 5, 10, and 15 trading days. That's what those red numbers mean. Okay, so 4 of the 18 calculations are positive. Not very much, no, not very high yet. On the red side, we have some that are quite high. So overall, we're looking at a statistical likelihood of lower market volatility using not only the statistical bands, but also the SKEW adjusted VIX bands, where we have more red numbers than blue even. There's only 2 out of the 18 that are blue, and those are quite low. So lower market volatility is what statistically is expected here, judging from the current market condition. Let's dive into the methodology of these in a little bit, but first I'd like to encourage you to subscribe by clicking on the button, the subscribe button, and also if you would like this free e-trading or e-book on options trading co-authored by myself and Jim Graham, just click on the link and we'll be glad to get that to you if you go over to that page and give us your information. Okay, now let's just dive into the first, the butterfly timing report, going through the methodology and get into the weeds here a little bit. First of all, we'll cover why you'd want to look at the report, the methodology behind it, and then the current condition and the edge level. Why would you want to look at this kind of a report? Okay, well, what we like to do is, well, in this particular instance, back then on December 31st, 2015, the market had started to channel around a little bit, and if you ran it through our calculations, it turned out that there was a minus 4.2% edge, a negative edge for selling premium. All right, now what that meant at the time was that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. And indeed, what happened thereafter is the market plummeted, got real volatile. So it can be predictive. Okay, but again, we're only looking at statistics here. This is a cherry-picked example, understood. But this is, I just wanted to show you, what can happen here. This happened to turn out to be predictive. Here's the current market condition as we just expressed. Here's the question on the table in terms of this report. Is this current condition a good one for selling option premium through range trading, butterflies, condors, etc.? Is this a good market condition to consider that? All right, so here's what we do to ascertain that. We observe how much the market actually moves from a close. We call that actual volatility. Then we're going to observe the market move that's predicted by the option prices. We call that implied volatility. And then we go in retrospect and we compare the two for any given bar. What was the actual volatility that occurred versus what was implied at the time? All right, and then we label those bars favorable or unfavorable in hindsight, okay, for selling premium through range trading. So let's just go through this. Let's just talk about the actual move. If we were to take a given close and go forward 21 bars and ask ourselves how far did the market move maximum in either direction, okay, we can see that in this case it went down 50 points, which turned out to be about 2.4%. That's the most it moved from that close moving forward. Now, there you can see the indicator at the bottom that we have there. Now, what market move was being implied at the time by the option prices? The actual move was 2.4. If we went and looked at the VIX and backed into the amount predicted from the 30-day VIX, the 21 trading day VIX, the 30 calendar day VIX, 4.4% at the time. So at that time, the option prices were implying a volatility or a market move greater than what actually came to pass. So that was a good bar to sell option premium through butters and condors because you were selling premium at a higher implied volatility than what actually came to pass. All right, so what we do is we paint all the favorable bars like that blue, all right, where the actual volatility was underneath the implied. And then there are some bars where the ensuing move was much greater than implied, and we paint those bars red. Got it? Okay, so that's how we do this, and what we're going to do is look at it historically. What percentage of all the bars going back in the S&P, back to Jan 2000, what percentage of those were favorable? Okay, then we take that, then we set that number aside, so that's our benchmark. Then we look at the bars that match our current condition. We only have 60 of them. What percentage of those 60 were favorable for premium selling? Okay, now the difference represents an edge that we might have. So in this case, we have, we go back Jan of 2000 moving forward, 65.2% of all the bars in the SPX from Jan 2000 to the present, 65.2% were favorable for selling premium through condors and butters. Okay, 34.8% were not favorable. Okay, now so that's the benchmark. That's the way. That's just the way that the volatility was distributed. Now let's go to our current market condition we got right now. Of the bars that match our current market condition going back, what percentage of those were historically favorable for selling premium? I mean, look, what happens if we go back and 100% of them were blue, were favorable for selling premium? Wouldn't you want to jump on that? Okay, what if it turns out that only 40%? On average, you could flip a coin and get 65%. Okay, but if we went back and looked at only half, well, then you know that you're operating at a negative edge here. In this case, 76.2% turned out to have been favorable bars, meaning that we have an edge, a condor butterfly timing edge of 11%, a positive edge. So this means that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. Okay, so that's the methodology behind the 11% edge. All right, so that's it for that report. Before we get to the other one, I want to make sure you understand Discover Options offers exclusive one-on-one mentoring services to help you get from a beginning to an intermediate to an advanced level options trader. We have money managers that have come aboard. We've helped them manage the money much better using more sophisticated strategies and understanding their true risk. And we have a great curriculum. You can go to the website and check it out. Give us a call, talk to one of the reps, and we'll get you in the right program to help you get to where you want to go. All right, let's go to the likelihood report. All right, and so we have the red numbers there. I already went over that a little bit. Let's go through the, let's just take a look at here at get in the weeds of this thing. Here's the current market condition again. Here's the question on the table. Since Jan of 2000, how often has this same condition occurred? And what did the market do in terms of direction and volatility? So we know it's occurred about 60 times. Now, of those 60 times, what did the market do? Did it go up, down, or wobble around for a bit? I mean, if we went back and looked at all 60 of those times and we discovered, hey, it went up most of the time, well, then we'd want to be bullish, right? Okay, so that's what we're going to do here is kind of gauge that and understand what it did. Now, here's how we do that. We do it through understanding distribution of price. This is different than just systems testing, all right, where you can optimize your trailing stop or whatever and have amazing results. Okay, that's not how we're doing this. We want to first understand the historical distribution of price. What does price do just on average? Out of those 4,200 bars, what happens over the next 5, 10, and 15 days? Then we're going to understand the distribution of price after our market condition develops. And then we compare the two to see if there's an edge. Here's how we do distribution of price. I look at volatility bands. These are one standard deviation band set from each bar's closing price. They're normally distributed, and we use a 20-day historical volatility to determine how wide the bands are. So here's just a quick example. All right, here's a close. Here's the upper band going out 10 days. The lower band is out 10 days. And the question is price going to go up and hit the upper band, the lower band, or wobble in the middle? Okay, so for this particular close, we can see that it took a day or so for the market to go up and hit that upper band. So for that particular close right there, we record that it hit the upper band. Now, let's look at the close up here. We have the upper band, the lower band, and in the ensuing 10 days, what happened? Okay, now just keep that in mind right there. And what happened is that the market tried to go down and hit that band, but it came close but no cigar. So for that particular close, we record that it hit neither of the bands. All right, so here's how we determine our distribution. From every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. That's how we determine our historical distribution, and here it is. And I didn't, cut and paste is the bane of our culture, I'm telling you. This is through 12/2. Okay, 4,225 occurrences. Okay, out of those 4,225 occurrences, price struck the upper band 29.3, the upper 10-day band 23%, 23% about, 29 almost 30%, 29% or so, and then 32%. So that is the distribution of price for the upper 5, 10, and 15-day bands and the lower 5, 10, and 15-day bands. This is just the benchmark distribution here. Okay, and it's not too surprising. Okay, I mean, if you take a bunch of bullish markets and bearish markets and average them all together, you're getting a pretty good dispersion of prices there. That's not too surprising. Now we're going to understand the distribution after our condition develops. So we take our condition and watch this. Going into Monday, I think it's going to be helpful to understand the distribution as of the close on Friday, but also on Monday, if price goes above Friday's high, we want to know what the distribution of price is after that, as opposed to it going below the low of Friday. Okay, I think that would be helpful in terms of trading off of, on Monday's action here coming up. So here's the distribution as of Friday's close. We take all 60 of those occurrences. Of those 60, 25% of the time it hit the upper 5-day band. And that's a little bit lower than the benchmark up here of 29.3. So you can see it's a 4.3% less often that it hit the upper band. It hit the upper 10-day band 16.7% of the time, 6% underneath the benchmark. Okay, upper 15-day band about, just slightly under the benchmark, about up lower. Then now we go to the lower bands. It hit the lower bands pretty much the same amount of time, same percentage. Look at this though. It hit the lower 10-day band 23% of the time, which is a bit underneath the benchmark, and it hit the lower 15-day band underneath the benchmark. So that's why we have 5 of the 6 calculations. It's hitting those bands less often. So this is a picture of lower market volatility. Does it mean that it's not going to ever go beyond the bands? Well, no. We just know that statistically in the past it's occurred less often with this particular pattern. Okay, now what if tomorrow, what if on Monday, price exceeds Friday's high? If it exceeds Friday's high, that's occurred 33 times. And here you could see again a picture of lower market volatility. Lower market volatility. It seems to, it's pretty much not striking. Yeah, it's pretty much even across the board except for this lower 15-day band. Let's go now to the, if price exceeds Friday's low, if it goes below the low, again we have red numbers pretty much across the board except for just 2 of these, which are very, very close to the benchmark. So again, a picture of lower market volatility there. Okay, I'm not going to weigh it bearish or bullish. I don't see anything striking. I would say this, I would prefer that we had higher levels of occurrences. I like to see something where the benchmark were at least around 100 or more. This is a low number, and it does, I think, decrease the validity of the study the lower you go in terms of that figure there. I wish it were up at 100 or even 200. Most of the time we're hovering around 100 or so. So I'm going to throw that out there before you really hang your hat on these things. Just understand that the population of occurrences is underneath what we would like to see. Now, what I like to do also is with these bands is I like to use a different volatility input. I like to use SKEW adjusted VIX figures to determine the upper bands, which would use a lower volatility than the lower bands. So the upper bands have a lower volatility input than the lower bands do. You see that? Still, we have red numbers across the board. I'm not going to call a bullish or bearish bias to this because we have red numbers so much prevailing here. So the best thing to do is just to say this is a picture of likely less market volatility than normal. We have the SKEW adjusted VIX figures down here. We're at 16.2 on the downside. I'm going to take that number into account when I give you an interesting trade idea here. Keep that number in mind. The SKEW adjusted downside VIX is at 16.2. So here's an idea. This is a hedged bull put spread. A lot of folks, the Condor traders, I know the upside can cause us fits sometimes when the market blasts off to the upside. So one idea is to do a hedged bull put spread, and you get the benefits of the Condor, but the upside is something you're not really going to be too concerned about. Here's what we do. We're going to plug in that 16.2 SKEW adjusted VIX. We create a bull put spread down here, 20 points wide. This is in the SPX 30 days out. This is 34 days out. Expires January 7th. Then with this credit here, we go purchase a small hedge, an at-the-money bear put spread, just a 1 lot versus a 5. We have a net cash flow credit coming in, and when we analyze this thing, you can see that no matter how much the market goes up, we're going to make money as much as 5% at expiration. If the market goes down, that hedge kicks in, and if it keeps going down but not quite a standard deviation, we're going to make not only the credit but also the full debit spread value, and we can make upwards of over 3 times what we're trying to make if the market goes up. So this is a very interesting trade. If you expect the market to go up at all, if you're bullish, then this would be something to consider. But looking at the statistics, this might be an interesting trade to consider. Okay. All right. By the way, here's the price chart with the profit region in green showing on that trade. Not too bad. Not too bad at all. Folks, thanks for joining us. We'll be back same time next week, and we'd love to hear from you if you want or interested at all in the one-on-one mentoring experience. Take care. Have a great rest of the day. Bye-bye.